Hello, everyone, and welcome. Trees simply don't grow to the sky forever. And we've warned against growth stocks and policy experimentation in our newsletters over the last few years. A very long period of easy monetary and fiscal policy drove interest rates to zero. Consumer prices have now increased dramatically as we enter a period of higher interest rates and monetary tightening. It couldn't be more timely to welcome a leader in the investment world to help frame this volatile landscape. I'm honored to welcome Matt McLennan, lead portfolio manager of the five-star rated First Eagle Global Mutual Fund, where he oversees $90 billion in assets. First Eagle has been a guiding light and an important partner for Staub Financial. Their disciplined investment approach to value investing with the goal of protecting against the permanent impairment of capital has served our clients well over many market cycles. Matt is one of the brightest people I've had the pleasure of meeting over the course of my career. His investment knowledge is accompanied by a temperament and intellectual well-roundedness that is second to none. Today, we talk about economic headwinds, how to think as an investor, and hot topics such as energy transition and markets. We end with a candid discussion of human tendencies, the importance of patience, and surrounding yourself with quality people, both in life and in investing.
Matt, welcome. We couldn't be more excited to have you today to share your thoughts and insight on the market, but also what makes First Eagle different than most.
Thank you so much. It's a pleasure to be able to chat with you today.
Thanks, Matt. Admittedly, Matt, I've stolen your line at times that the crystal ball is foggy at best, and our clients are thankful that you've had a continued focus more so on what can go wrong versus Goldilocks scenarios and soft landings. Could you frame the current cycle and the forces that have emerged in terms of inflation, geopolitics, and financial experimentation?
Well, I'll give it my best shot. I think the basic problem that we find ourselves in right now stems from the fact that when we went through COVID-19, policymakers saw it as a demand shock and fundamentally underappreciated the supply shock nature of COVID. And so they responded reflexively the way they'd done to prior crises, which is with demand stimulus. But this time they doubled down and delivered record demand stimulus. And I think what's made matters worse, even as those supply chains are starting to free up now, is that there's not much of a structural productivity story to fuel supply growth. We have an economy that's moving to services from manufacturing. We have an increasingly regulatory backdrop. We have aging demographics. And so all of these things are kind of headwinds. And if there's not a supply side story and you've overjuiced the demand side of the economy, then ultimately you're going to require a demand side adjustment in the economy. And the problem is we've let the wage inflation genie out of the bottle, and it's hard to get that back into the bottle, without a traditional recession. And so the Fed is doing, I'd say, what it can right now to try and rein in some of the excess demand, and it does that through tightening financial conditions. But if the Fed succeeds in slowing nominal growth while wage inflation is high, then that implies a margin squeeze for corporate America. I think the exogenous factor that made all of these forces worse is obviously the Russian invasion of the Ukraine, which is an incremental supply shock on top of all of these forces. And so I think, we found ourselves in a difficult situation because of the reflexive tendency of policymakers to really want to stimulate demand. And now the Fed put has really essentially become the Fed ceiling.
Well, the Fed put is a great comment. Do you see it as officially over, or is this just an ICU type of scenario where Powell is doing this and this is potentially short-lived?
Well, look, I think the Fed, is serious about wanting to get inflation down, but I think the true moment of policy resolve is going to happen once the telltale signs of a potential recession take root. And I think it's probably more likely than not that we move back to an easing policy framework. Although one of the constraints that we have is that we don't have a lot of fiscal degrees of freedom. We essentially spent the latent fiscal stimulus in COVID and in the wake of the global financial crisis. And so, we might find ourselves in a situation where the Fed wants to pivot to easier policy, but may not be able to do it as much as it would want if wage inflation is still a little higher than the targeted 3 to 4% level that they want. Wages are currently growing at close to 7%. So there are some emergent constraints. And so I don't know that we get the kind of post-COVID unrestrained Fed put that we had last time, nor the same sort of fiscal response. So I think we're entering into a more complex dynamic here.
Sure. And mentioning the recession, your thoughts on stagflation. Is this setting up to be potentially a reminiscent of the 70s, if there is a playbook for this?
So there are some historical parallels to the 1970s. We had back then a similar energy shock. We had some productivity issues given certain policy initiatives in the early 1970s. We had a Fed like today that got behind the curve with Arthur Burns back then. And as a reminder, we also had pretty easy fiscal policy because of the Vietnam War. And there was actually even a pandemic in 1968. Over 100,000 Americans died. So there were some similarities. And I think when stagflation took root in the 1970s, it really flipped the nature of what did best. Real assets like gold did particularly well. Energy, obviously. Cash held up well relative to long duration assets. And so what we've seen year to date has been a kind of small microcosm, if you will, of what took a decade to play out over the 1970s. And I'd say that we already see some economies around the world in stagflation, and the US may be heading that way as well. So it feels to me like we already had a taste of what stagflation looks and feels like based on the year-to-date performance of markets and the deceleration of global economies while inflation is persistently high.
Yeah, and the odds of the soft landing that we've talked about have been low. And you've warned against concept stocks and IPOs for quite some time, similar to what we saw in the late 90s, I guess. And so explain the history of First Eagle during other bubbles and crises, and the position of the portfolio today, along with being benchmark agnostic.
Sure. And while you were asking that question, I was still thinking back to the stagflation question. So I just want to clarify one point there too, which is that one difference from the 1970s is that our debt levels are a lot higher than the 1970s. And ultimately, inflation is a monetary phenomenon. So if the Fed succeeds in jacking up interest rates sufficiently high that we get into recessionary territory, the focal point of the market could quickly turn to disinflation concerns again, given the levels of debt we have in the economy and the inability of fiscal authorities to really ease fiscal policy, given how big our stock of government debt is. And so if I could leave you with one thought, is that we have a wider volatility of potential inflation outcomes than we've had for some time, both on the upside and the downside, and that's probably got to be reflected in the risk premia for various assets in the coming years. Now, as it would relate to sort of prior bubbles and buying opportunities and whatnot, I just say for the long-term decade investor, and we do think over decade cycle time at First Eagle, the arithmetic of investing has made more sense of late. We have selectively taken advantage of certain opportunities in the year-to-date environment because we're getting better free cash flow yields and businesses that we think can keep pace with the longer-term nominal growth in the economy. But just to be clear, we haven't deployed our last dollar of ballast. We have ballast both in cash and in gold as a potential hedge. And the reason we haven't deployed our last dollar is that we're not yet in recession. We're not seeing widespread earnings misses yet. We've seen them selectively, say in the retail sector, and then that's backed up into some areas of consumer discretionary spending. We've seen credit spreads blow up, but we haven't yet seen the credit losses emerge. It's more of an expectational moment that we're in. And we've seen some minor signs of the labor market slowing, but we haven't seen payrolls decline. We haven't seen the JOLTS data roll over. We haven't seen wage inflation come down. And so the point I guess I'm trying to get across is that while we're in this anticipatory phase of a slowdown, the arithmetic for long-term investors has improved, but one has to be open-minded to the possibility that you may need to weather a further 20% drawdown if anticipation turns into reality. Now, were that to happen, that could be a sound opportunity to deploy some of the ballast, because if equities are lower and potentially gold and bonds could be higher in that state of the world, then you may have some interesting opportunities. I think that the thing that kind of worries me most is that we've had this meaningful sell-off in markets, but we haven't yet seen the long bond rally. Okay, and usually when a recession's really being priced, it's reflected in the long end of the yield curve starting to move down. And I look at some of the long dated bond ETFs, and they're still hitting new lows right now.
I was at the First Eagle due diligence conference in March of 2009, just after you took over. I think it was your first conference, and that was ironically within days of the bottom of the market. We just didn't know it at the time, but your temperament and your confidence resonated greatly, and you called that an all-in buying opportunity. And so what you're saying basically is, you're deploying cash now, but this isn't anything like what you saw in December through March of 2009.
It's not there. And just to give you some comparative data points, back in 2009, the market troughed below 10 times the trailing peak level of earnings. When the S&P earnings peaked in 2007, it was, I think, around $84 a share or something, and we got below 840 on the S&P 500, below 10 times trailing peak earnings. On a last 12 months basis, the earnings for the S&P 500 are around 205 or something. So we're still trading at like 18 times. We're a long way above the kind of valuations that we saw in the global financial crisis. And in fact, if I look at really all of the recessionary environments since World War II, the market's typically cleared at around 15 times or lower the trailing peak level of earnings. Now, it's not to say that it will be exactly that way again, because history doesn't exactly repeat itself. But my simple point is that in moments of macro distress, the market's often cleared at lower valuation levels than today. It feels pretty harsh what we've already experienced, but it's because we came from pretty extreme valuation point.
Yeah, we barely hit the average during the low of COVID, if I remember correctly.
Yeah, that's right.
So, Matt, explain more on how you think as a value investor and owning stocks versus renting stocks or indexing.
Yeah, so Warren Buffett and Charlie Munger said something interesting in their most recent annual report. They talked about the fact that they weren't stock pickers, they were business buyers. And that really resonates with me because, if you look at our portfolios, our turnover is quite low. It's pretty close to 10%, which means we're going into investments with a decade perspective. And I think that makes you think a little bit differently to the traditional investor who's trying to time the quarter and zig and zag around risk on and risk off moments in the market. And it forces one to take a stand back and say, well, look, what really matters? If the goal is to avoid the permanent impairment of capital in real terms, you need to sort of take a long-term perspective where you're willing to own companies that, for one reason or another, control scarce assets, either physical assets or scarce market position. They are dominant in a small niche of the world economy, because these kinds of businesses will go through their ups and downs. But in a portfolio construct, if you can own businesses that have scarcity value, you've got a better shot of keeping pace with inflation over time. And these businesses tend to also, if they occupy an economic high point, if you will, tend to generate better margins and therefore better cash flow and better ability to endure crises and emerge stronger on the other side. And so for us, as thinking about long-term investors, leads one to a place where you're very selective about the nature of the business that you want to own. And secondly, it's not enough to buy a good business. You need to buy it at a conservative price. And And for us, the Venn diagram overlaps, if you will, when we find the right kind of business and we can see a path to a satisfactory return because we're getting a mid-single digit or higher free cash flow yield typically, and we think the business can grind out mid-single digit organic growth. And it's that combination of prudent pricing or a margin of safety in price and the underlying assets or market position of a company being sound that get us sufficiently comfortable to deploy capital. And you'll note it's nothing about who's going to beat the next quarter or trying to time the exact bottom of the market or the exact peak. It's really about, it's more like being a business gardener where you're planting seeds and letting time pass. Whereas the alternative of owning an ETF is a low cost decision, but it's essentially a decision to be willfully blind, if you will, to the strength of market position, capital structure integrity, management behavior, and even valuation. And so you have to understand that if you're going to take a low-cost solution of owning an entire basket of securities, that there may be times where you're exposed to those kinds of risks. And it's a personal trade-off that one has to make, but there is no free lunch in markets. We're great believers in selective participation in markets, and I've used the analogy in the past of carving away at the block of marble so the statue emerges, as opposed to just owning the entire block.
Yeah, because it's not what you own sometimes, it's what you don't own.
Correct.
And so you touched on scarcity, Matt, and I'm not going to bother you with any crypto questions today, but the gold position is an important one, and we've seen a little sell-off, as you actually alluded to a few months ago. Can you explain the gold and the role of scarce assets, both tangible and intangible?
Sure. Well, gold is the ultimate scarce asset in some ways. It's relatively fixed in supply. The per capita supply of gold has been pretty static for decades, and there's not much of it. There's less than 1 ounce of gold per capita in the world, and it's not just scarce, but it's useful as a potential monetary hedge. And the paradox of gold is that it's often criticized as being useless as a commodity because it's relatively chemically inert. But that's why it's useful as a potential hedge, because anything that's useful, like iron ore or copper or any other commodity that you can name in farmland, is going to have sensitivity to the health of the economy. Whereas gold's inertness means that it tends to actually have a more inverse relationship. In fact, it tends to be more inversely correlated to real interest rates. And so you have something that is scarce and doesn't trade with a lot of correlation to the business cycle. Its beta relative to equities is close to zero and sometimes negative in tail states of the world. And the other thing I'd sort of mention about gold is that because it's of its chemical characteristics, it pretty much lasts forever, right? It doesn't rust or waste or corrode. So it's nature's version of a zero beta perpetuity, if I can sort of summarize it. And I've looked across the periodic table. I've tried to find an element that's better suited to that, that's scarcer or dense and inert. And I can't find one. Some of the denser elements are useful as catalytic converters like platinum, or you get too dense and you get radioactive. That's not particularly great to hold in the basement safe. And some of the other inert elements are gases. You can't really store them cost effectively. And so gold has got this kind of uniqueness about it due to its density, its scarcity, its inertness, that it means it's kind of like a block of land, right, that has permanent option value for better use. And the reason that all matters is that if assets are in relatively scarce supply, they tend to accrete in value with money supply. Now, for most other things that aren't scarce, they go up in line with CPI because they're facing new supply from competing products or productivity improvements And so while you've had 5 or 6% money supply growth for the last several decades, many other assets have only grown 2 or 3% a year, whereas gold has compounded out at closer to 8%. And I'll just make a sort of final point that gold has been a little weak of late, and that's not unusual when you have this kind of tightening liquidity phase of the cycle. We saw it, in the back half of 2008. We saw it during March of 2020, that when real interest rates are going up and policies tightening, and indeed money supply hasn't grown this year in the United States, gold suffers a little, but then when the consequence of that tightening policy kicks in, when you get a crack, if you will, in the economic resilience, that's when gold tends to show its best. And so, gold is a strange beast, but it sometimes shakes people out just before it has its best days.
Yeah, like it did following the financial crisis.
Correct.
So, the future is uncertain. We've heard that from you for years. We've heard that from John Marie and some of our favorite investors. Can you touch on the difference, though, between risk and uncertainty?
Yeah, that's a great question. Because I think most people who exist in markets are taught that risk is a kind of a normal distribution type phenomena, that you can estimate a standard deviation, and what's a 1 standard deviation or a 2 standard deviation event, or you try to calibrate it precisely into a tracking error estimate. How does your portfolio diverge from the market on average statistically? And that's all well and good, but it's just not how markets behave. Now, there's another concept which is quite different from risk, which is called uncertainty. And uncertainty is a different kind of beast, because to model true risk, is the way we think about statistical risk, isn't really risk per se. We know it presumes that the underlying distribution of returns. It's like tossing an unbiased coin. That's not so risky if you can toss it 1,000 times. You know the expected range of outcomes. Uncertainty is when you don't even know the distribution, when strange things can happen that haven't happened before. And in fact, markets tend to behave more that way. In fact, they tend to behave in a complex, nonlinear way, and they tend to sort of follow more of what I would refer to as a power law distribution of outcomes, which is there's a fatter left tail, if you will, than a standard deviation model would predict. And very bad things can happen, albeit with low frequency, but very bad things can happen. And so knowing that markets are this kind of complex, nonlinear system, I think helps one look at markets differently. You don't over calibrate your leverage or your expectations about what markets can do, and you structure yourself to be a little bit more resilient. And so I think it's a really important distinction, that one between risk and uncertainty.
And then, Matt, having some energy exposure has been a topic of conversation, and a positive one. Your thoughts on ESG and the move to EV, for example, and your thoughts that it's going to take longer than expected?
Yes, I mean, look, as long-term investors, sustainability obviously matters to us, right? We're trying to identify businesses that we think have staying power, that have good governance, and that are ultimately going to be on the right side of change. But the reality is that some of these issues are very nuanced, and I think when people think of ESG, and I think implicit in your question with the comment around the EV transition, is a focus on the energy transition itself. And the history of energy transitions is that they've taken a long time to play out, in fact, many decades. And one of the things that we've been saying for several years now, and I think it's been borne out this year in the unfortunate wake of the Russian invasion of the Ukraine, is that one of the complex features of energy markets is that you have to balance energy security with energy transition. And as Prime Minister Modi in India said, one has to think both ecologically and logically about matters pertaining to energy, because you're talking about the most consumed commodity in the world. And one of the things that we started to become concerned about was that even before COVID, the period of low oil prices was starting to lead to a period of underinvestment in the energy complex. And that was exacerbated by incentives for people to accelerate the energy transition. And then COVID struck, and you had a period of very, very low prices, in fact, negative prices for spot oil. And so, we started to become more and more concerned about supply side of the energy equation. And, for us, we have some energy investments in the portfolio. And, in part, we own those businesses because they own what we believe to be some of the best assets in the energy world, whether it's upstream resources that are advantaged on the cost curve, or downstream assets that have unusual scale and density advantages. But also in part because they provide a potential hedge to a high equilibrium cost of energy. Much of the rest of our portfolio is a consumer of energy. And so when you're thinking about constructing a portfolio, being short the most consumed commodity that's been underinvested in for a period of time would seem like a dangerous thing to do if your goal is to avoid the permanent impairment of capital. And so, we viewed it as a kind of a prudent measure to have some allocation to energy in light of that. And I would just sort of point out that, if you think of an upstream company like Exxon, and you think of the EV transition that you raised, only about 30% of oil goes into automobiles. And it will take quite a long time to transition that. And many of the cars that are electric in nature and plugging into the grid at night are being powered by gas-fired turbines. And gas is part of the solution. In fact, the key reason that CO2 emissions are down in the United States over the last couple of decades is the increasing role of gas at the expense of coal. And so, if you look at Exxon, roughly half of its upstream portfolio is oil, but the other half is gas. Yep. So it's and there are many parts of the oil-based portfolio that are growing, specialty industrial lubricants, for example, and as feedstock for chemicals that are used in the everyday products we have, from iPhones to eyeglasses. And so, the simple point I'd make is that the demand for these products is more stable, I think, than people appreciate. And the supply was more at risk because of that period of preceding low prices. And so there was a role for a prudent investor to own some exposure.
If there is one tidbit to give an investor today that may kind of go against conventional wisdom, what would that be?
Well, a few thoughts. I mean, I would really want to get across the power of patience. A lot of people come at investing because they've got a goal to create wealth quickly. But that often leads you into a place of taking risk that is more sort of binary in nature. And I think the willingness to have a longer term perspective and be patient can provide substantial long-term dividends. In fact, if I think of the sources of excess return and the approach that we seek to employ, the key drivers for that really come from much longer term forces, valuation, mean reversion, which often takes many years to play out. If you buy a business that controls scarce assets, the benefit of those superior cash flows and margins may take some years to accrete to you as a shareholder. If you've identified a management team that are going to act like owners, their accretive decisions make a difference over years and not just quarters. And so taking a long-term perspective, I think, can position someone to pick up those sources of excess return that'll actually lower risk in nature. And secondly, if you want to create wealth in investing, you've got to identify asymmetry between price and prospects. It's not enough to identify good prospects. There has to be an asymmetry. And so, we think it's not just enough to find a good engine, but there has to be an issue. And so the longer your time horizon, the more you're willing to identify fundamentally good businesses that might have been through a lost decade for one reason or another, and then own them for the next decade, as opposed to just trying to find what's going to deliver good short-term results. And so patience, I think, even though it sounds self-evident, is something that most investors are probably lacking a little of. And so I view being patient as an investor as kind of contrarian in nature. I think one of the other things I would sort of share is that as we look at the economy top down, I think the dominant mindset in markets and professional forecasters and policymakers today is the Keynesian mindset that we have to play this active interventionist role in stimulating demand when we have episodic slowdowns. And I think at First Eagle, we have much more of a belief set that aligns with the Austrian school economists that fundamentally believe that there's no free lunch when it comes to policy stimulus, that there's always a second order consequence. And often that manifests itself over time. And I think we've observed over the last couple of decades where we've had this sequence of very low periods of very low interest rates and wide fiscal deficits, that the response in the economy has been to take on more debt. Yep. Because essentially you've promised stability that's not intrinsic to the system. And so you've built up a greater systemic vulnerability because of these cumulative efforts to ease. Now here we are with an inflation problem, and the Fed put has gone away when investors want it most. Yes. And so I think we're starting to pay the price, if you will, for excessive reliance on Keynesian policy. And one of the greatest contrarian investors of all time was Richard Cantillon, and he existed back in the early 1700s, and he recognized that a liquidity bubble could inflate stock prices, and he benefited from that. But he was also smart enough to know that it would ultimately undermine the currency. And he made his real money having protection against that.
Last but not least, I'm always so impressed in meeting your team at First Eagle. The humbleness and the temperament is always, it resonates with me. Can you explain the culture at First Eagle and the importance of investing in people long term?
Well, the first thing that we try to get across in the culture is that, yes, we have some analytical mental models that we hope are advantage in the way we tear apart financials, and we think about how to value companies, and we think about how the world works from an economic standpoint. But the real competitive advantage that has to come from within a culture is one of temperament. And we spend a lot of time at First Eagle trying to get people to reflect on matters of temperament. And I think if you read history, you see that while technology's evolved a lot over the last couple of thousand years, human beings continue to make the same mistakes. And mistakes of hubris or haste or being dogmatic. And so we try to get across to our team members, and we try to lead by example that you have to have the humility to accept that the world is an uncertain place. Back to your question of risk versus uncertainty, and that makes you prepare for resilience rather than just maximizing. Survival becomes a sexy strategy in that world. Secondly, I talked about the importance of patience. Well, that's the opposite of haste, right? The kind of mistakes that people make. And we try to really teach people patience. We don't want an idea a week from our analysts. We want a really thoughtful idea, maybe once a year. And we want the analysts to follow that for the next decade. And then, we don't want dogmatic thinking. We really want a willingness to look for opportunities wherever they may be in the world, so that you can be both diversified and selective. And so getting the temperament right is a critical competitive advantage. And what we've tried to do at First Eagle is to create an operational environment where we hope that our analysts can do their life's best work. We give them long-term to prove out their performance. We let them look globally. We let them specialize within that global search, and so they become advantaged in certain areas. We have a great diversity of backgrounds on the team, and I think at the end of the day, we're kind of geeky. We look for people that we think are sort of smart and nice. And if you were to sort of walk around the offices here at First Eagle, I think you'd feel that it's much more like a library than a locker room. And that's an important part of the culture of the firm.
I love that, Matt. That's a great place, I think, to stop today. We're glad that the portfolio isn't sexy and that you're doing what you're doing. Matt, this has been absolutely wonderful today. Thanks for your stewardship and your guiding light. We appreciate your partnership. We truly do.
Thank you so much, Corey. It's great to catch up, and I appreciate the wonderful questions.
Thanks.